Well, the price reductions just keep coming. Last week, when mortgage rates hit 7%, the Phoenix real estate market saw 4,427 list price reductions. That's 24% of all active listings in MLS did a price reduction, and 50% of those reduced their price by $12,000 or more. And according to the Fed Chair Jerome Powell, he is saying this difficult housing correction should put the housing market back in better balance. And list price reductions are one of the ways this begins to happen. The only problem is, right now, with these higher interest rates, it's pretty much wiping out all of these price reductions. Why? Well, even with a lower purchase price, a higher interest rate is not lowering your overall monthly payment. So the overall affordability of homes is not getting any better, if at all. And because of this, we are seeing a decline in buyer demand, which just makes homes sit on the market longer, which leads people to reduce their list price. Not to mention, the fourth quarter of any market is when we normally see things slow down. So as we head into this normal slowdown time in our market, it is likely to be more pronounced. I think it is safe to say that right now we are in that housing correction in the Phoenix market. How does a housing correction impact you? Are there areas or sectors of the market where prices are being impacted more than others? And what am I seeing out in the market right now? If you read any national news article, you will see and hear them say that the market peaked in June. Well, in the Phoenix market, we actually peaked in May, which is not surprising. We have a tendency to feel the effects of a shifting market sooner than most markets. And I've talked about this on my channel before. We knew the market was starting to shift when we started to see the increase in list price reductions begin back in March. From there, we have just seen them steadily increase over the months. At the same time we saw our list price reductions increase, we also saw our inventory increase. Coinciding with all of this is when we saw the Feds raise the Fed's funds rate for the first time. That was the first shift in our market, and sellers responded accordingly with all of these increases. And now the Fed has continued to raise the Fed's funds rate in an effort to tamper down inflation, but that just hasn't happened yet. The biggest fear when it comes to the housing market and this is that housing is a slow-moving indicator, meaning that we will not see the effects of what's happening today for 30, 60, 90 days until we get a contract to close. That's when we'll realize what has actually happened with the decisions that they've made today. So while some are looking at housing as a major number in the pie of inflation, some believe we need to tread lightly in this area because we have already seen the number of mortgage applications for a primary home decrease, as well as the number of homes under contract decrease, which is leading our market into stagnation. As I have said in the past, the Fed's fund rate rising does not directly correlate to mortgage rates rising. However, until everyone can say that we are actually in a recession, this is when historically, in a recession, our mortgage interest rates will start to decline, and they will usually decline just as quickly as they increased. Now, if you have listened to the Fed, they have never directly said that they want to crash the housing market. However, they have said that this is going to be a painful correction, but in an effort to bring things into a better balance. So what does this really mean for home price appreciation? Well, we have already seen it decline month over month from the peak to now by about 8% here in the Phoenix market. And if it continues on like this, those that bought a home in 2022 could see their overall home price appreciation at the end of the year be zero. For those that put down a large down payment, this does not affect them all that much. However, those that put down a minimal down payment, should they lose their job and have to sell their home, this could lead them to a distressed sale. Now, do I see this happening a lot? I don't, but could it happen? It could. So the reality is that in our current market, 66% of those homes that are active on the market right now, those sellers have owned those homes for longer than 2 years, meaning that they've taken advantage of the massive appreciation we've seen over the last 2 years. So if they have to reduce their price by a little bit, sometimes maybe a lot, they still are going to be walking away with a pretty substantial amount of money. Now, I know some people believe that in our current economic situation, we are going to see widespread job loss. But I want to share a few charts from the Greater Phoenix Economic Council that will just show you how strong our current job and employment sector is here in the Phoenix area. Now, keep in mind also that our unemployment has been lower than the national average over these few years. In 2022, there have been almost 11,000 new jobs created here in the Valley, and almost 4,700 of those are high-paying jobs. Then you have to take a look at all these additional companies bringing new jobs, more new jobs into the Phoenix market. And this is all good news for our overall job outlook, as we go through this challenging housing correction. We did not have any of this during our last downturn. The reality is that we are seeing those sellers that are the most desperate bringing our home prices down. And for the most part, those are not regular sellers. Those are iBuyers, builders, and flippers. Now, I did a whole nother video about how you have to look at these iBuyers as a completely separate animal, and that their home price appreciation had dropped significantly farther than regular sellers have. Now, the builders have shareholders and cannot hold on to vacant homes, so that's forcing them to lower their prices as well. And the flippers, if they have a hard money loan, they have got to get that home sold quickly, or the carrying cost is going to eat into any margin that they had as a profit. The unfortunate thing is, as long as we have these types of sellers, these desperate sellers in our market, they will bring prices down. But that doesn't mean that it's happening with a regular seller. The regular seller just has to know that they are likely going to be on the market for a little bit longer than they were anticipating. Again, just to give a little context to where we are now versus the 2008 market crash. As you see on this chart right now, our supply and demand are together. This just further demonstrates the stagnation that we're seeing in our market versus how far apart they were in 2008, where you see the demand line is right where we are now versus the supply line over the demand line quite significantly. This is what forced prices to plummet in 2008. So what am I seeing in the market right now? Well, I'm seeing buyers' ability to negotiate. And I have seen some homes listed on the market do a $200,000, $300,000 list price reduction before they get an offer on their home. However, this crazy market, I have also seen homes sell for higher than their list price. That, however, is not the norm anymore. I am also seeing a lot of canceled and expireds, which is good for those real sellers. Those that don't need to sell or don't want to sell at a reduced price are just going to stay in their home. And those that really need to sell, it has reduced their competition in the market, thus keeping inventory low. Because of this, I do believe we're going to continue to see home prices drop, but not plummet. If you'd like to take a look at the video that I did about how iBuyers are hurting our market, you can watch it right here. If I can answer any questions at all, please feel free to reach out. As always, I thank you for watching, and I'll see you next time.